right? Specifically, let's talk about the credit default swaps. Everybody heard about this, whether you watch The Wolf of Wall Street. It was the thing that made all the money back in 2008, 2009. Let's talk about what a credit default swap is. If you don't know what it is, let's talk. I mean, look at the chart right now, right? Walk me through this chart like I'm a 5-year-old, Garrett.
Walk you through it. Okay, so I thought I was asking you that question. You were supposed to ask me a question about batteries. We've already moved on. So what we do? So
we already hit the SLI, buddy. We nailed that. You hit that early. That was great.
All right. So credit default swap, it's a financial contract. It allows an investor to swap or offset credit risk with that of another party. So think about it this way. Back in 2008, there were lots and lots and lots of people taking out mortgages. So the companies that effectively owned the mortgages or owned the tranche of mortgages wanted to ensure that they had insurance against the possibility that 3%, 5%, 8% people default. That ultimately knocks the whole bundle out. So what they did, they went to AIG and they purchased a contract known as a credit default swap, that in the event that they had massive amounts of defaults all at the same time, and these mortgages became worthless, all of that risk was transferred to the third party that sold the insurance to them. The comedy behind it was that AIG did this with everybody because they thought it was a great business, that housing would never go down. And that is why AIG had a $10 billion hole a week and a half before Lehman Brothers collapsed and ultimately required lots and lots and lots of money that you as a taxpayer will never know about. So here you have these credit default swap, the demand. This is the highest level of demand that we have seen since March of 2009, which happened to be the bottom of the financial markets here in the United States. March 2009 is when the Fed stepped in because of the contagion in the markets. You can see there have been other periods of time where credit default swap demand was accelerating. At the end of 2011, that was back when the United States government was fighting over the debt ceiling, and of course March of 2020 when COVID had occurred and there was a lot of uncertainty. So you are seeing the most amount of concerns about credit risk that we have seen since 2009. That is not positive. That doesn't mean that the market can't squeeze higher, but it certainly is another warning sign for these markets. These are the 5-year credit default swaps for Credit Suisse. Thoughts? Anything to add, CJ?
You know what? It's an interesting thing, and you nailed it in terms of the description of them, and it's all different banks that get covered by this. If you mentioned AIG and they're kind of the provider, think of it as writing that insurance check every month, and they have to pay to keep those credit default swaps going. This is not like an option that you buy once and it's done. You have to continue to pay your premium on these, and the fact that is going to continue to rise and people are paying in. You remember in the movie the where Michael Bird just kept going. They had to keep going almost to the point where it broke their back. That's what's weird about this market. The other side of that, though, are the banks. And right now, when you look at Europe, and we get a little bit deep into Credit Suisse and Deutsche Bank, at the same time, you've got banks that are being backed by the government. I'm just curious because it adds a little more to this Rubik's Cube here. How do you think that when the government comes in, and especially in Europe, starts to back up the banks more and more and more and more and more because of the energy trade, whatever the reason is, how does that extend those credit default swaps? And are we going to see them go way higher because of that? Because you said it's a warning sign, and I think that's an amazing point that people have to understand. This is not the end, maybe, but it's a yellow light flashing on your dashboard.
Chris, I honestly don't think the government matters in this. I think what matters the most is the banks. And if you go back and you remember what happened in 2008, why was it that Michael Burry wasn't getting paid? He wasn't getting paid because the financial institutions, the hedge funds, everybody else wasn't marking down the assets on their books. Right. So right now, think about this. You've got a lot of illiquid investments out there. Could be venture capital stuff. Could be, again, it could be the housing that all of these institutions have been purchasing. There are a lot of assets out there. And if they're not marking them down, that is clearly reflected in the market as well. Some of these banks are probably a little worse off than you would think that they are. But until they start to mark down their book, that might be 3 months from now. That might be 6 months from now. That might be 2 years from now. Burry kept banging the desk saying, that's why we're not getting paid. Same thing with the guy with the guy who played the guy from Greenlight Capital. But key thing here is this type of thing all kind of builds up, and then when they get this stuff off of their books, and they probably aren't going to be able to because they did it in 2008, and a lot of people got screwed in the process. That's what the movie Margin Call is about. What happens here is when they finally do, the markdowns could be pretty significant. You may see a number. Right. Again, I think there's going to be a lot of bankruptcies in the next 6 to 8 months, but we're not going to see it until it all kind of happens at once. There was a month in 2018 where like 6 retailers went out of business, and a month earlier, everybody was saying, no, Sears is fine. Toys R Us are fine. It's all going to come all at once. And in the meantime, you have a market that is squeezing higher because everybody is so short right now.
Yeah.
Like this is the most 8.1 to 1 put to call ratio. That's 3 times more bearish than we were in 2008. And all you need is a little bit of buying, and you get into the situation where we are in right now, where the SPY can go to 415, go to 430.
Yeah. You know what? You brought the chart. You just hit all the points of that. You have any time frame? You just said 6 months. I mean, this is something that it doesn't have a definitive time frame. What's your bottom line takeaway from that chart?
The bottom line takeaway from that chart is that we are in a financial crisis, and we have to act like it. I think that's the key thing. You don't have anyone on CNBC or out in the financial world or even in politics, because we have an election coming up, that are pointing to the distinct dangers of this economy and this market. So you see the numbers there: 2009, 2011, 2020, and 2022. What do they all have in common? They were all financial crises.